Righto, money miners. Very quick quarterly wrap up coming up, as quick as bloody MMS can get gear on your site to start moving open pit dirt. That is how quick. That is like we're doing this segment to highlight how quick they are, because the gear's there. The gear can be moving dirt probably lunchtime.
Pressure's on for us to be quick.
Yeah. I'm going to make it quick because I won't be as quick as them, obviously. Hey, boys, Trav and GC had a bit of a special guest come in this morning to shoot the shit a bit.
Yeah, we did. We had Jake.
I don't know if you know it. Did you know him?
Nah, I hadn't come across him. Jake Klein, exec chair of Evolution Mining. He popped in the studio, had a bit of a yarn. He's one of those big thinkers in the industry. He's always got something a bit kind of, out there that he wants to talk about, a few talking points. And today we went in the weeds of some of the, very strange government policy decisions that we've seen out there, like the rug pull of McPhillamys and the implications that has. Obviously, he's Evolution, not Regis, but was happy to talk about it, which I think was important. Also, Australia's relationship with China and kind of the big theme of deglobalization and what that means for a lot of the industry. And then, of course, I couldn't help myself but ask about deals, future deals for Evolution.
As per predicted, he gave you nothing.
I reckon there was something there, but I have to re-listen.
Righto, let's rip in. First off, cab off the rank, Sayona.
Mate,
Go Lithium.
Go Lithium, yeah. I just thought I'd point out, just wanted to point out kind of what stood out. This was just one of those ugly waterfall charts. Not much on it. Looks very good.
It looked all right until you read what the item was.
Yeah. You look opening cash, closing cash. Oh, cash went up. So you think, did they make money? But no, the ones that go down include group underlying EBITDA, negative 18 million. But the thing that went up was this net working capital movement of 46 million. What they put that down to is customer prepayments and drawdown of ROM inventory. So, it gets me a bit nervous because those prepayments are now future obligations that Sayona must satisfy via production, and delivery bears real cash cost to the business, and there's risk that will be loss making too. So, I found it interesting. They did some hedging as well, but I like from what I kind of pieced together, I think what they've done is that there's some short dated contango in the market. They can actually get a bit of an uplift on selling kind of near term inventory as a result of that. I wouldn't imagine it's for too much, but
it said limited hedging. So
yes, and fun fact, I had someone tell me that Sayona is going to have to spend 22 million this quarter on exploration to get the flow through financing kind of credits and all that sort of stuff.
Yeah,
anyway.
Old chestnut.
Yeah,
right. Good sum up. We're just going to talk about not the numbers, just interesting shit in this. Northern Star. Pretty flat. It was all pretty stock standard, but hedgebook is interesting for FY26. As they said in a call today, everyone starts talking about hedging in a rising gold price environment, and as they said, hedging never works in a rising gold price environment. That's pretty. Can't say it any more simpler than that. More about trying to guarantee long-term returns.
Works great when you pick the top. You hedge right at the top, and then gold price falls.
Yeah, exactly. So because they've guided to 2 million ounces for FY26, but nearly, you look at the hedge profile here, and nearly a third of that is hedged at an average price of $31.50. So it's funny when you look at the numbers, like the effect on large scale producers like this. So like hypothetically, let's say gold was 4,100 or stayed at this level all FY26, their realised price would be a bit below 3,800. So that's a hedge impact of also almost $200 million just in that. So, or it could go down, and it's all good. So, but you think of an average realised price of potentially 3,800 when they were doing the KCGM expansion, FID, and everything, they would have taken that any day of the week. So that's what everyone talks about when the price goes up. You can see the declining grades and ounce output at Carosue Dam a little bit. Back down to 2.6 for the underground grade. They did point out in the call that it was part of the mining sequence. It's an easy one to say.
Yeah.
Obviously, higher open pit material moved. Not sure if there were cutbacks or something, but like mill head grade back down to like bang on 2 grams a tonne. All-in sustaining costs up $300 an ounce, 2,100. Always wondering if this trend were to continue for lowering grades, increase of costs, would it get Northern Star to the point when they would consider offloading Carosue Dam to the logical buyer, Ramelius, for their Rebecca Road project? It's
2,100 all-in sustaining costs, almost a 50% margin.
Yeah.
These days. So it could be worse.
But you can get, I think you'll hear in the episode later with Jakey, like this is when you should be selling assets, not buying them in a gold price environment.
Well, I think you've got the marketing challenge of not hitting 2 million ounces then.
Yeah,
So-
that's it. That's it. And that's what I guess, and we always come back to that point of just seems like it's not never going to happen, but not in the short term that they're ever going to offload this.
Yeah. Yeah. Playing the waiting game for sure. You've been tracking the declining grade at Jundee last time they reported too. Did you? Look at that?
So it wasn't two. I looked, it was 3.3, I think. So
yeah.
that fucking looked all right. Yeah, it was pretty bloody. Yeah, just doesn't, as you say, JD, you take 2,100 at the moment. So
You would.
it's they're not going to want to give it away, that's for sure, because the bargaining chip they've got against Ramelius is the water infrastructure installed by Greenlands from the Southern Borefield.
Interesting.
That's right.
Yeah.
Interesting. Tell me about this.
Well, like you could see that probably adding, I don't know, 100 million to the price tag. Like, because you look at all the work that Greenlands did there at Carosue Dam, like the bloody redevelopment of the existing bore fields that like supply the bore pumps and the transfer pump station. Mate, another example of Generation 7 AI-driven telemetry and leak detection systems. Like that's like unparalleled. Bloody,
That's amazing.
And I've heard like the water pipes they install are like those BMW car tyres, effectively self-healing and puncture-proof. Like that is like just state-of-the-art water infrastructure. So to be the first time in M&A history where water infrastructure will have such a large effect on the price tag and the outcome, I believe. So
Could have
it's
been
just something else to keep in mind.
could have been the poison pill. They were like, we're gonna use Greenlands to just make all of this super jazzy, and then they're not going to pay up for what this is worth now as a result.
Yeah, when you're not
It's worth
handing
so
over
much.
a poison pill, they're like a
Yeah.
they're like a Panadeine fort. Like they just make everything better.
It's definitely better. Yeah,
They're definitely better.
it's definitely better.
Right, Metals X.
Ding ding.
Yeah.
ding, by the
So,
way.
I think it's been a bit too long since we've spoken about the mighty Metals X. So worth a little chinwag again. They're trading around 43 cents. So doing all right at the moment. Pardon me. So Renison had a record tin production quarter. So things are actually looking pretty good. I'll just start quickly on the operational side of things. They mined 2.9, or they produced rather 2.9 thousand tons of tin at an all-in cost around 30,000 Aussie per ton. Now, tin average about 47,000 Aussie, so that gives them about a $17,000 margin per ton. Obviously, Metals X own half of the operation there, so about 1,500 tons is their share, and that kind of equals net cash flow of $24-ish million. And there's a couple other costs that aren't included in that. That sort of runs at about $10 million per annum, or $2.5 million each quarter. So 22-ish million is the cash flow. The financials themselves aren't the cleanest because of the JV structure, but those numbers I just said are the ones that matter. Cash flow was better this quarter than it was last quarter, which is also good to see, especially in the face of the tin price being about $2,000 on average lower over this quarter. And there's one other detail to kind of look out for. It's kind of confusing when you read it at first. They report Renison 100%, but they own half. So in the table that they show, you want to half those numbers, or just double check what you're kind of looking out for there. On the repurchasing side of their stock, obviously it was a big deal 4 or 5 odd months ago when they announced the buyback. They've bought back just under 10 million shares. So about $4 million. I don't think we need to go through again. They could probably do a bit more on that front, but we've spoken about that. One of the interesting things to look at, though, is that paid up to 40 cents. So I'd be keen as the announcements come out day by day and they keep buying back the stock, whether they're going to go over that 40 cent mark or if that's a sort of internal limit they've got in place. And just looking at the valuation, so $197 million in cash. If you go through the net receivables, inventory, unearned revenue and payables, there's around about $18 million. So a bit over $200 million, you could kind of call that in cash. market cap of 380 million. That gives you an EV of 170 million. Gets a bit better than that. They've obviously made an investment in First Tin, and they've got a few other investments in like Nico and a couple other companies out there that they mention in the quarterly. But like most things, it sort of screens cheap for a reason. They again talk about maybe they will do M&A. They're looking at base metals and a couple other things, but always a super, super interesting company to keep tabs on.
Yeah. You look at operating cash flow was 22.7 million quarter. Annualize that, you get 90 million bucks, sort of, 91 million annualized operating cash flow. EV, you said 170, like net off the investments, depending how you get funky with the Cyprium con note and how you want to treat that. We can just call it an actual EV, like call it 150 million. Find me a lower sort of EV divide by an operating cash flow multiple on the ASX for any company that has like a 10-year reserves life. I'll be shocked. But
you
like
might
you
be
say,
looking for a while.
it's like the big risk is that they spend the money on something silly. And that, there's plenty of other risks that we've talked about in the past. But yeah,
a lot of potential though.
Right, next cab, Antipa, the Minyari scoping study.
Yeah, so we won't run through all the numbers. Money miners can just sort of have a squiz through that at their leisure. But there's a few sort of interesting talking points. I guess we spoke a bit about it in the context of Great Land. Infrastructure is one of those interesting talking points. The roads are a bit cooked out there. They need a bit of work on them. Obviously, the other key point to talk about is the fact, or the question rather, do they need to build a mill? So they're analysing a 3 million tonne per annum standalone scenario here in the scoping study. Pre-production capital is 300 million. About a third of that goes towards the process plant. They've got about 90 of that going towards pre-production mining capital. So that is a sort of point of debate, and other people in the area can sort of run their own numbers over it. But the stock has had a pretty decent run of late. You look, zoom out the past couple of months and the thing sort of 3x. Now, obviously, you've got the Great Land deal happening in the vicinity there. You've got Antipa themselves signing off the deal with Rio over Citadel. That'll sort of net them 17 million bucks in cash. And then you've got gold price running. So 3.1 cents, they're capped at about $130 million. Once they wrapped up that Rio deal, like I said, 17 million, that'll take their cash to 23-ish million, leaves them with an EV of $110 million. There's also, so that there's 4.7 billion shares outstanding, 850-ish million options, 650 now well in the money now that the stock's run up a decent bit. So if the stock holds up at this level, wouldn't be sort of surprised to see about 14% dilution over the period. Sort of, they've got staggered expiry dates from 25 to sort of 2026. But yeah, I think that'd be a bit more dilution, but all up, it's still pretty interesting to look at. And I think the real kind of chat to have here is like, what happens next? So we've heard a couple rumors that Great Land, I think Antipa would put these ones out there, that Great Land might use them to make their way onto the ASX. I think there's sort of various tax reasons and other sort of implications why that might not be the most sensible kind of way to go for Great Land to get themselves onto the ASX. Also sort of worth noting, this is just a scoping study. I know it's in the area, but the numbers are plus or minus 35 odd %. So yeah, I mean,
it's run 200% since the Great Land deal a month ago, which is kind of remarkable.
Yeah. Yeah, I mean, in the context of gold price running hard as well, maybe a few of these sort of juniors having a bit more attention put on them, but it feels like all of a sudden a heap of people are looking at that sort of Patterson province and maybe gold sort of developers or small caps more broadly, right?
I reckon
there's no mill getting built there. It's going to Telfer. That's just 100% certain.
Yeah, I reckon that like whether there's a merger with Great Land or not, I reckon all depends on, like, realistically, what is the time frame you could actually get that feed into the mill? Like, are there permitting challenges that are actually going to blow out? And when you've got a bit of a fall off in the mining schedule that could be filled, can you actually get the Antipa ore in there at that point in time? If not, then you wait longer.
Yeah, no, it'd be good to sort of see where they kind of go, like scoping study, the the historical sort of timeline from scoping study to getting something in production in recent times is quite a few years. So be keen to see if they sort of expedite things. Maybe they sort of skip a study phase or something like that and really start putting some of that money they got in the ground and use some of the newfound love to maybe raise a bit more in time and really hit things hard. Kind of see, I'm sure the conversations have picked up a bit of pace in recent times in the boardroom there.
I think it's you'd think it's simple. You'd think, right, they're just going to mine it, crush it, truck it to Telfer. No cyanide, no processing plant, no tailings management, anything. But speaking to a person like an MD going through the same process at the moment, they think you think it's simple, but it's still waiting in line, waiting for the permits and the department to review it, and you're just like, might take 6 months for them even to look at it, even if it's simple. So that's the headwinds these companies have got in our great country.
Crazy.
Yeah, I mean, I do think these guys have plenty of work themselves that they need to be doing in their own time.
Oh, but even
well,
when they get to that stage, it's just bloody hard work. Right, should we get into the? You gave a good summary at the start.
To Jake, yeah, we actually talk a little bit about some of that, government stuff going on. So you'll enjoy it, Matty.
Let's do it.
Let's go.
Jake Klein, thank you for coming. Last time we spoke was in the front bar of Debo's. Actually, I was like, and here we are. Now you're sitting in front of our bar in our studio. Welcome to Money of Mine. We're stoked to speak with you again.
Thanks, Travis. Really happy to be here. Shows you the success you've had. We're now in a proper studio. It's very professional.
Oh, I appreciate that. Yeah, no, we're not in Kalgoorlie anymore. But last time we spoke as well, you were pitching the merit of gold to be cool again. Gold is now cool again.
It's very cool.
So keen to know what's on your mind. Again, now that your prophecy to make gold cool again is actually true, it might be a bit too sexy. I don't know what your thoughts are on that.
Yeah, I mean, I think there's lots of reasons why we can debate why the gold price is going to go higher, and I think it may well. But from a gold miner's perspective, we're entering kind of a high risk phase for gold miners. This is the time, that gold miners have proven themselves when the gold price is as high as this to be poor custodians of capital. And I'd hate us to do that again. So I think I'm nervous because a $4,000 gold price is phenomenal. But I think investors still remember the scars they have from the last time the gold price is high. The sector weren't good custodians of capital, and we've got to prove them wrong this time.
Do you think the sector will be able to do that, or do you think that human behaviour it's just the way it is? People are short-term incentivized, short-term motivated, short-term thinking, and they want growth for growth's sake because they're incentivized on production targets or whatnot.
I'm concerned because the narrative that we've heard from investors, even if you look at, say, Evolution, where it was, we've been through a tough period for the last couple of years. We've had a decent couple of quarters. This last quarter was particularly good. We were making money. And the narrative went a little bit from some investors, well done, you've delivered, but how are you going to grow now? And I think that's high risk. From our perspective, we just want to bank that money. If you look at Evolution and you think we're producing 750,000 odd ounces of gold, and the gold price is $700 higher roughly than what we planned, we should have $500 million more cash in the bank in 12 months' time if the gold price stays like this. And I think that, to me, is going to be the acid test from investors. Can gold miners convert the high gold price into money in the bank?
Yeah, or even more explicitly, can they convert it into returns to shareholders as opposed to kind of I think the gold industry in particular has a tendency to want to grow via acquisition or expansion or etc. All these kind of either inorganic or organic potentials, but they don't often think about the use of capital in dividends, and buybacks are an afterthought in the industry.
We have generally been poor custodians of shareholders' capital. When the gold price is high, we tend to spend it quickly and then realize when the gold price is low, maybe we spent it too quickly. So evolution is very focused on trying to be counter-cyclical. That's what we've said right from the beginning. When the gold price is high, we should be banking the cash, and that's what we're trying to do now. When the gold price is low and you've got potentially some distressed or motivated sellers, that's when we should be acquiring things. So I think my mantra is there is a time for deals and there is a time for making money, and now is a time for making money.
We had some questions for you as well, Jake, around just some broader issues in the mining sector. It feels like we're a bit of a crossroads here in Australia between where, inaction in trying to, achieve these sort of green ambitions, and then but actually, developing and investing in the mining sector and downstream capabilities and things like that. If there's inaction, it's going to cost us. It feels like everyone knows that this is something we should be doing, but no one's really taking charge.
Yeah.
And doesn't seem to be a very long-term view or approach or plan. Do you think the politicians are getting too caught up in politics? Is it the private sector to drive? How do you sort of think about all of this?
I think we're at a fork in the road. We've become obsessed about short-term decision-making. Maybe it's our election cycle, but there are very few things that we can agree on a bipartisan issue and a bipartisan approach. So if you think about it, the last 30 years have been incredibly successful for Australia. China emerged as our largest customer. We've been selling iron ore and coal to China, and they've had insatiable demand for it. The iron ore price when I first started in the business 30 years ago was $25 a ton, and Australia is producing about 120 million tons a year. And today we're producing almost 1 billion tons and selling it to China, and the iron ore price is $100 a ton. So that's 33 times more in terms of revenue. The mining industry has delivered $365 billion in fiscal tax windfall to the government of Australia. And that has put Australia at the very top of global GDP per capita rankings. We are a rich and wealthy country. My concern is, how do we future-proof the next 50 years? Because our resources are going to get more difficult and challenging to mine. The world seems to have changed where globalization is effectively over, and China has emerged as a very significant competitor in terms of resources. If you look at their companies that they've created, Zijin is a $67 billion company. This is a company that was a state-owned enterprise 20 years ago. And they have a very good access to cheap capital. They're very ambitious, and they have very strong government support. And so if you're in Africa today and you're trying to secure ground in Africa, your biggest competition is going to come from Chinese competitors.
It's one of the few places, with excellent ore bodies, but where the Chinese are allowed to actually still acquire projects as well.
Yeah, so if you think about it, I was involved in China in the 90s and 2000s in a period of amazing collaboration and cooperation between China and Australia. It was like a sense that China's definitely going to integrate into the world, and it didn't happen, and it hasn't happened. And China has used that period to create these companies, fortify itself, and kind of go almost on a separate path. Maybe they've been more successful than we have. But our incapacity of being able to think any longer than one election cycle seems to be a massive disadvantage to us if we're dealing with a strategic competitor that is thinking long-term and investing long-term.
20 years ago feels like such a different time as well, right? Because when you were running Sayona Gold, this was an ASX 100 company at the end, which had mines in China. It's kind of a bizarre thought these days that that sort of vehicle would even exist on the ASX.
Yeah, it was. I mean, it was an amazing experience. It was crazy. It was formed by a few investment bankers from Macquarie in the 90s, myself and Nick Curtis and a couple of people. We went to China. We knew nothing about mining and we knew nothing about China. And Nick is an amazingly optimistic entrepreneur who said, do you think we can build gold mines here? And I think we must have been at a bar because we said yes. And one thing led to another, and eventually Sayona Gold was formed.
Anyone like Jake out there thinking of bloody building mines in China anytime soon, that's bloody CRE insurance on the blower straight away. Jesus Christ, it took him some minerals to go and bloody do that, didn't it? The Sayona Gold journey.
It was a different time, mate. No one in Australia is going to be building a mine in China anytime soon, but they will still be looking in places where you need bespoke risk to be priced.
The new Chinas. I mean, mate, Jakey must have had Steve Tarr holding his hand through that process. I can't think of any other way that you would have felt comfortable taking that amount of risk. Like some sensational insurance broking was in place. Like Tari, it's got Tari's name written all over it. Like, because miners shouldn't be scared of international mining. You don't need to be. You give Tari a call in CRE Insurance Perth headquarters, and mate, he's an international mining insurance expert, and which means Australian mining, he can just do it with his eyes closed, blindfolded, facing the other way.
The more bespoke the risk, the more excited he gets. He loves the esoteric stuff, mate.
But he still will do the boring Australian stuff if you need him to. But he does it that quick, it doesn't matter. CRE Insurance, give him a call.
And he run his eyes over your report right now. Just let him have a look at yours.
Free.
Free.
So back then, the view, like it was a real globalization agenda. China was opening up to foreign investment. The investment community was trying to embrace that and capitalize on that. Was that the kind of?
It was, but kind of thinking we were smart Macquarie bankers, we were thinking about an arbitrage. So if you think about a planned system, which China was at that time, where the geology wasn't really viewed from a market perspective. So ounces in the ground weren't valued from a market perspective. They were only looked at as units of production in a planned system. So we went to Jinchuan nickel mine, which is in the Gobi Desert. This was in 1994. And we one of the plates that was served for dinner was a camel's foot, which we were told was a delicacy. I'm still trying to get over it. But there are obviously a lot of three-legged camels in the desert, but it really was a camel's foot. And we are being told in all seriousness by the president of this organization, who was wearing a Mao suit, and I think the ore body, it's one of the massive nickel ore bodies in the world, that their production crew mines one level every couple of years, and the development crew, develops 2 levels a year. And we kind of said, how many levels ahead is the development crew? And we worked out it was kind of like 12 years. They developed the mine 12 years ahead of where they're going to produce.
Wow.
And we kind of said, why? And he said, well, the development crew develops and the production crew produces, and that's how it works. So they were really in a planned system at the time. And we kind of saw that as an arbitrage. If we could get people to understand the value of what's in the ground, then there's clearly a value uplift. I think what we underestimated is how smart China was, and how they weren't going to do what Russia did, which was privatize all of their assets and basically put it into private hands. They allowed us to experiment, I'd say, on kind of B-grade deposits and build the first foreign-owned gold mines in China. The safety standards that we implemented at our first mine, I think, have formed the foundation of the national safety standards. So people were learning, listening, utilizing, and it was amazing. But China today has learnt not only from us, but from going outside of China. And these companies like Zijin, Jiaojin, Shandong Gold are formidable competitors.
Yeah, wow. So it's funny, you went there with a view because you thought there was an arbitrage because they didn't know how to mine properly. But really, the Chinese we're using you as the arbitrage to learn how to mine properly and then apply it everywhere else.
I think that's well said. We didn't realise it, but yeah, we thought we were doing the smart thing.
Yeah.
And I guess in contrast to Australia and policy, making and affecting policy here, do you think, and just sort of in reference to sort of the Regis situation earlier this year with McPhillamys, do you think our government is adequately educated and informed about the practicalities of mining and how mining actually works in order to actually put these policies in place and affect them appropriately?
No, I don't. I think that was a terrible decision, and I think it's something we've got to address, that something so late in the process comes up and causes the project to approvals to be rescinded, because New South Wales has one of the most rigorous approval processes in the world, and Regis went through that only to have it overturned at the last hurdle by a federal decision. So I don't think so. I think the other thing that we as an industry need to do more of is educate, particularly East Coasters, about the value that mining is contributing to this country. It only employs 2% of the workforce, but our contribution is in double digits. And this country just would not be where it is today without mining. So I don't think we sell it well enough, and I don't think our reputation is what it should be in decision makers who have the ability to make decisions like this.
I mean, the Regis one's like the standout, But there's other examples of sort of similar stuff happening here in Australia, elsewhere as well, and it feels like a complete disconnect from the big thinkers who set the policies or enact the policies versus what's actually required from a certainty perspective to make an investment decision.
Yeah, I'd say that Australia is still, once you have the permits and once it's approved, you can sleep easy at night that you own the asset. In China, I had plenty of sleepless nights wondering whether I was going to wake up the next morning and we didn't own the asset. So it is a great mining jurisdiction, but I think we have the opportunity to make it greater. And decisions like what happened with Regis detract from that.
Yeah. Would you say Australia is getting sovereign risk?
No, I wouldn't. I still think Australia is a great place to mine. Yes, it may be becoming more difficult to permit. But I think, again, we need to do more as an industry to educate East Coasters. I have young adult children, and their peers. They don't understand mining other than it paid for their schooling and education, my kids. But I think we can do more to get them to recognize that mining is so critical for this green energy future that we're all talking about and committed to. Mining is critical to the success of this country and is part of the future of this country.
And do you think that's also quite a large contributing factor to sort of the talent pool that probably isn't growing as fast as it should be entering into the mining industry as well? Sort of this wokeness in some ways?
Yeah, I do. I think it's terrible that there are fewer positions in universities today in the geosciences and mining engineering than there was a decade ago. That's terrible. It's not setting ourselves up for the future. If you think about opportunities in Australia, you think about what can we do to value add these metals that we're mining. Why are we happy to kind of ship everything offshore and have it processed elsewhere? Education, I think, is an opportunity for us to be the kind of the Ivy League standard of education globally. Same with capital markets. If you think about resources and the fact that the tech space has grown so much that resources is kind of less relevant to a New York fund manager, but in this country, it's so important. We could be the epicenter of capital and debt markets for global capital raising. So I think there's a tremendous opportunity. I'd love people in the tech space, young people who are thinking about the next breakthrough in technology, to be thinking about mining, but they're not. They're thinking about deliveries, from pizza restaurants.
I even think of it like, if you're a young and hungry young person, you always want to be running in the direction where like everyone else is running away from. It's like way easier to compete in a small pond. Like,
Yeah, well, you guys are have recognised that and have done an amazing job in building this business. So, why aren't more people seeing the opportunity which you saw in the mining space to not necessarily be miners or a mining company or mining contractors, but is podcasting technology?
Yeah, I think so.
Media technology. You guys have done that, and you've created a business. So more people doing this would be fantastic.
Yeah, don't encourage the competition, Jake.
No, but I did hear. I think Michael Vaughan was telling me on our way in here that he was talking to someone overseas who said, "Yeah, they always listen to your podcast."
Yeah.
You mentioned the building out the sort of downstream capabilities, or those other pieces of the value chain, which certainly aren't as present in Australia compared to China and other places. We've seen some companies make an attempt at it, and it's just proved awfully expensive and taken a lot of time and things like that, which certainly doesn't incentivize much others to go about it. But it certainly needs to happen. So do you think does the government sort of step in here? Do private the private sector just need to just go for it? How do you sort of see that going forward in Australia?
I don't think the private sector will just be able to go for it, because at the moment those projects don't make the returns which private capital requires. So it needs some sort of government support, and there's a debate to be had as to where that government support should be. But fundamentally, if you think about it, and this is maybe a strange way to look at it, but maybe the paradigm has changed. In the 70s, Australia had a manufacturing sector that all got demolished really by China's emergence, and everything now is manufactured and produced in China essentially. But if you think about technology in the next 20 years, and you think about our aspiration, maybe we can actually deliver it on green energy, which should be cheaper once it's been built. If you can provide cheap green energy and you can use technology, maybe manufacturing or processing, downstream processing, is not as far out of reach as we think. But it requires a different paradigm, and it requires a commitment from government to support that sort of initiative in things that really strategically are well thought through, and then can deliver returns on capital.
Yeah, I'm a cynic on that one.
Yeah.
I just think that like history is littered with times where government has tried to prop up a sector that doesn't stack up in the private markets, and then you either lead to inevitable like subsidies that never end, like regulatory capture, all the things that don't actually create a competitive industry in the first place. I think government should do everything they can to make the private sector returns better by investing in infrastructure that could reduce the cost. But I will perennially advocate that the government doesn't sort of
So I think that's a fair point. But so part of the infrastructure is this transition to green energy.
Yeah.
So if you think about all the commitments we have at the moment in terms of delivery of that green energy, I think we need to have a conversation about the timeframes which people expect it to be delivered, and the cost of it. Because we're talking about the replacement of a significant piece of national infrastructure. At the moment, we have federal targets, but the delivery of that federal target is actually is dependent on each state delivering to their target, which is not necessarily aligned with the federal target. So if you take the federal target, I think it's 43% reduction by 2030. I think New South Wales is 50% by 2030. I think Queensland is 75% or 80% by 2035. If you think about the Snowy Hydro projects, it started with a $2 billion budget and it's now at least 12, maybe 14, and who knows what it's going to cost to finish. All of the projects to deliver those targets should have been started now, and none of them have. So if we committed to, you've got to build out 32 gigawatts of power, I think in each of the next 3 decades, and 32 gigawatts is a lot of power. You've got to put transmission lines across a lot of Australia, because you're talking about a dispersed grid. just as an example, at Mount Rawdon, we're talking about this converting our project to a pumped hydro project. There's a transmission line of 27 kilometres, which covers 15 landowners. And it's taken us 2 years of extensive engagement with those landowners to get about 14 of the 15 on board.
It's one holdout.
So well, it's not a holdout, but we can take it round there. But it's taken 2 years to talk about 27 kilometres of transmission lines. My point is that there's only two ways that the energy can be funded: either tax today or higher power prices later, which is unacceptable. So we've got to pay for the infrastructure. We've got to agree who's going to pay for it, but then it should be cheap green power in the future.
Should be.
Yeah.
Should be. But yeah, and there's a trade-off on the capital intensity of the infrastructure investment in the first place. Like, if we adopted a nuclear strategy, then that's arguably less capital intensive. There's less transmission lines required.
Yeah, well. And I'm all supportive of everything being put on the table. My issue at the moment is that we have these targets, but we have no real plan as to how we're going to deliver those targets, and we don't understand how much it's really going to cost. Governments are there, and just going back to your point, governments are there to implement and deliver that infrastructure. Now, nuclear should be on the table. All of the stuff should be on the table, and we should have a comprehensive nationwide plan, not a kind of target announced before an election with no understanding of how to deliver.
Yeah. While we still got you, Jake, I can't let you leave without talking about deals.
Yeah.
Evolution is a company that's got a reputation for being like a deal doer, both acquisitions, divestments, the whole works, and the company's been awfully quiet since the acquisition of North Parks, and it was about 12 months ago that acquisition was announced, maybe December last year. December. So nearly 12 months. And there was, like a bit of a shaky period in the market there. Share price, fell off. Bad quarterly came out in January. Then gold rebounded strongly, and kind of the balance sheet sort of fears faded, and the business is pretty cash generative again, and sort of happy days. Does that mean that deals are back on the table?
Not really, because I think if we think in a counter-cyclical way, now is not a time to be doing deals. The gold price is high, the copper price is high. There's no distressed sellers out there. They're anxious buyers. I think in this type of market, you've been better off being a seller than a buyer. But just going back to the North Parks acquisition, we think it's an outstanding deal. I think investors are starting to understand it. But it was a pretty bruising deal. Like if you're doing deals counter-cyclically, people aren't cheering necessarily at the time you do the deal. So you really have to have some fortitude. And I was surprised because I thought it was going to be a really well-received deal. And there may have been a whole bunch of factors related to it, but it was a pretty tough deal to get across the line.
Yeah. Like when you acquired Cal, everyone thought you paid too much for that as well, right? And then in time sort of, I'm certainly guilty of this. I'm quite critical of deals where it's just like, on a multiple perspective, or even like on a P/NAV perspective or whatever, it might appear pretty expensive, especially if it was a competitive sale process as well. I'm like, well, you had to pay up for that. And then, what I'm learning to appreciate over time is that the assets that have quite like a very long life, expose themselves to the super profit period of the time when commodity prices like flex up and down, and pay handsomely thanks to that, and you have longevity through the cycle too.
I think so. So, Cal was actually bigger than our market cap when we bought it. But it was an asset that was really going to transform the company. And we'd done the deal a couple of years earlier, or a year earlier, with Naguib Sawiris in La Mancha, and he underpinned the equity raise. And it was always with the strategy that he got involved to try and get this company into a better space. And Cal came along, and I don't think we could have raised the $400 million if he hadn't cornerstoned it with the $100 million. But just going back to kind of what deals make sense, we've always said, we'll only do things that improve the quality of the portfolio and that are accretive to shareholders. And I think each deal we've done has. But, if you're looking at how do you create value in these deals, the easiest and best way is from geological discovery, because you're pretty much modeling what is there, and what is it that gets you that geological upside, and that's a geology call where our team has been really good. And majors generally put themselves in places which are geologically most prospective, and that's been our kind of hunting ground, buying from majors that have established themselves, but maybe the asset has not been core to them, and they've been a bit distracted, and the asset comes available. It's happened at Ernest Henry with Glencore, Cal from Barrick, North Parks from CMOC, and all of them I'd put in that category where the real upside is through the discovery and the better geological setting than people understood, because the asset has not really been profiled. I mean, just going back to the analysis piece, which you guys are expert at. One of the things which I think is challenging is that an NPV model always prioritizes capital upfront and penalizes long mine life in some ways. Because beyond 10 years at a discount rate in 7%, you're not really getting value for anything beyond 10 years. And there's always, your model always looks better if you can bring forward capital and accelerate production, which I don't think is right for the business.
Kupernik put out a written piece on that, just that very point, I think last week.
Right, I didn't see it.
Yeah. But you're right. And there's the optionality piece. Can you accept, like what if you were just to purely maximize NAV on a long life asset, then you get a NAV that's much bigger, but you're not going to, all the cash flows come in a different phase of life, and there's a bunch of factors. But the strategy of evolution has always been to like gradually over time make the portfolio have lower cost assets that have longer life.
Yeah.
Everyone wants to do that, and not everyone does do that. But part of that too is also divesting the assets that are in the portfolio that have the higher cost and shorter life too.
So we've divested of 3 of our assets. Mount Rawdon, which is coming to the end of its life as a gold mine and being converted to a pumped hydro, is the only asset that remains from the original 5 that we started Evolution with. So we have been happy sellers of assets. We've always tried to keep some insurance to make sure that if we were wrong, that we got paid for it. And Craco, Edna May, Pajingo are all assets which still pay us a royalty or some sort of upside, given that they're still operating.
And how do you find between that sort of approach to your asset portfolio, how do you sort of balance that with the pressure from, say, investors and shareholders to say, what's the next step? How are you going to get bigger when getting bigger mightn't necessarily fit with the internal strategy?
Yeah, it's an interesting one because, I think, the most important thing, which is really difficult to do, is to not listen to the noise and listen to your shareholders because they are the owners of the business, but try and not be distracted by the noise. We've had this very clear strategy. It's worked. The challenge for us at the moment is that we've actually put ourselves into some really good assets, where as you get better assets, the degree of difficulty in finding assets which are better than the assets that you have is increasingly difficult. And that's the challenge. So we see a lot of organic growth in our portfolio at the moment. Right at the moment, it's, if you think about the processes that are being run for assets and the values that are being obtained for the assets, they seem expensive.
There was one like reflection I had when sort of going through the history of deals of Evolution, and it's a shame we don't see deal making as riveting as this anymore. But even the initial deal which created Evolution, in a lot of ways, you were at Conquest, which I think when you joined it just had a feasibility study on Mount Carlton.
Yeah,
you picked up Pajingo, but then in an interconditional merger with Catalpa, which had Edna May and 30% of Krakow, but on the exact same announcement of that, done this equity raise, bring in Newcrest as a major shareholder, and you acquire the other 70% of Krakow from Newcrest plus Mount Rawdon at the exact same time. You just don't see deals like that anymore. And then over time, like in Evolution had this period of just like super funky deal making, like real funky deal making. You know, the like La Mancha stuff, like all of that was like very funky. But then over time, the deal making gets a bit less sexy. You know, you're just buying stuff in sale process and all that sort of stuff. But that's just a comment on the whole market. Deal making is a bit less sexy now.
Yeah, I'm not sure. I mean, just going back to Conquest, I mean, we've had a really interesting time. Like, so the reason we got involved in Conquest is because it was a high sulfidation epithermal deposit, which had a feasibility study done on it that used a biox or roasting process and found that it would be uneconomic. So we actually in China had built a very similar mine where we'd run out of money. And we figured out that we could only sell the concentrate in China. So we sold the concentrate. And one of our colleagues, who's still in Evolution, ran the Jianqialing mine for us in China, or was involved in it. And he went off to China with a few bags of concentrates samples from Mount Carlton and got us an offtake contract, which allowed us to build Mount Carlton without any of the downstream processing, you know, the biox, and we just sold concentrate, which was amazing because Mount Carlton made like $100 million for a few years until it ran out of gold. But yeah, I don't know. I think, you know, what are the sort of attributes you need in a good deal? You need a motivated seller, and probably at the moment they're not motivated sellers in gold and copper. They're motivated buyers.
There's a lot of motivated buyers.
Maybe in lithium there's some motivated sellers, but we're not going into lithium. You know, you need a view on the geology, and then I think one of the challenges in the sector is I think management teams have inertia about doing deals because everyone thinks that they're undervalued and the person approaching them is overvalued. And there needs to be a bit more kind of collaboration and boldness in getting deals done that really make sense for all sets of shareholders.
So in that example, Catalpa, they had the 30% of Krakow, which had a right of refusal on the other 70%, which kind of came in from Eucharist, but at the same time, Catalpa was under, like St. Barbara had bid for that a month earlier, and then you know, sorry St. Barbara, not doing that deal, we're doing this one instead. It's like three parties coming together, thinking this is the best outcome, and the pro forma sort of benefited everyone in a lot of ways who got to ride the benefit over time. Do you think there's less collaboration for those sorts of?
Well, so again, that was kind of done with a major. So Newcrest were the counterparty I went to go and see when they bought Lihir, and Greg Robinson listened and sort of understood that Mount Rawdon and Krakow, his 70% of Krakow, were not going to be core. And he kind of bought into, okay, well, I'll own 33% of this new vehicle. But he said, you know, in order for it to get done, Catalpa have this preemptive over my 70%, so go and see them and get it done with them. But he lent in and helped us get Catalpa over the line as well, because once they'd endorsed it, a major, you know, I think it did have an influence. So he was very supportive of the deal and created Evolution. And Laurie Conway, who's now the CEO of the business, actually was the non-executive director appointed by Newcrest. So I think if you're dealing with groups that understand how value is created, it can be done. But you need it. You know, you need to think a bit out of the box. And if you do everything that every investment banker walks in and says, you know, here's a great deal for you, you're probably going to end up in tears.
I'm not an investment banker, but I got a deal for you.
Yeah, I'm all ears, always.
I'm sure it's at the top of your shopping list anyway.
Yeah,
you've the East Kundana joint venture. You know, you've picked up sort of Northern Star's share of that now. Surely there's a motivation to wrap up the entire thing with Rand and Tribune of these funky sort of strange ASX companies that are mostly bullion. Pretty sure they're like, negative EV if you net off the actual bullion.
I don't know if that fits in the funky category. It just sounds like a purchase. We own 20% of Tribune. I think that the Tribune and Rand companies, have been somewhat esoteric to investors. Their shareholders are not institutional shareholders. So I think where we've gone with that is to try and engage with them, collaborate with them, and maximise the value at the EKJV. We're the 51% owner of the joint venture. That material gets processed in our plants. So our approach has been to try and collaborate and maximise the value for both shareholders. Again, I think, if you said, is it a deal that I could genuinely say is accretive to our shareholders? I think based on value expectations, the answer is no, and therefore unlikely to be done. So sorry.
Oh, you would say that. You got any more, Ellie?
No, that was fantastic. Thanks for your time, Jake. We
Been
really
awesome,
appreciate it.
Thank you.
Thank you so much for coming in.
Thanks.
Good stuff, Trav and GC. Fun random fact. Do you know that the term holy snap and duck shit got recently used in a corporate review meeting?
No. Really?
Anyway, I've heard word on the decline. Anyway, back to Jake and evolution. Good yarn, Trav?
Yeah, it was good. It was good. I thought it was pretty interesting. I did enjoy it.
What do you reckon he gave you that you didn't think he gave you?
On the deal front, you know what I was thinking when he said a deal can't be done with random tribute, but he accepted that they're trading at negative EV. I don't understand how that works unless the major shareholder or the controlling shareholding interest actually just has stars in their eyes. Because, mate, you know what I mean? Anyway. Yeah.
Who knows?
Yeah.
Who knows? I know MMS are the best open pit mining contractor in the world.
That's a fact.
That's there's no Rand or Tribune bloody cryptic messages there. It's like fact. Hey, what else is going on? Where's the sponsors gone? Are you testing me?
I think we know them.
Mate.
We've got a couple others to
We've
thank.
got the Grounded Construction Group. We've got CrossBoundary Energy. We've got the Sandvik Ground Support division.
CRE Insurance that we mentioned in the show.
Greenland's Equipment, McMahon Mining Title Services, Australian Earthworks and Haulage, bloody K-Drill just punching RC and diamond holes everywhere, and our bloody beautiful friends at Spark, if you're an active ASX trader. Hootaroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.